Eric Mwather with Mwather.com. In this video, we are going to be looking at the aspect of the market where we all have to respect the idea that anything is possible, and it also looks at the idea that we should never fall in love with a stock, and also the idea that we have to be careful when things are not going in our favor, that maybe there's more downside. Just the fact that a stock has been trading in a range doesn't mean that it cannot violate that range and make much lower prices. Anyway, so this video is going to be a little bit unfair because it's going to be on hindsight, but we can only learn on hindsight. So everything we're looking at here is on hindsight. It seems very easy after the fact, and I do acknowledge that, so do bear with me. But I'm trying to stress a point here, which is anything is possible. The reason why I'm doing that is you'll find that people sometimes will make comments like it can't go beyond that, or it can't do this, it can't do that. Yes, it can, and it does. So let's all be aware that markets don't really care that much about our personal opinions. It just does what it has to do, and it don't care. So the fact that we think it cannot, could do, is irrelevant. And I'm going to show you some charts here just to reinforce the idea that you have to be careful about the potential downside and the potential upside, and also the idea of sometimes stocks do make round trips. Let's take a look at ANR. Now this stock was a screaming, absolute screaming stock, jumping from about mid-teens, early 2007, all the way to 120. I mean, that's a 1,000% gain in about 18 months. But because of the market crash of 2008, the stock made a round trip, moving from 120 all the way back to pretty much where it began the move. So you got this move up, move down, there's your move back to where it began. Looks like a triangle there. It's amazing. So anybody who was buying the stock here or here or here, thinking that it has to go back to the 120s, I'm pretty sure was surprised to see it go back to where it had come from. And again, you see it eventually did move from the mid-teens again all the way back to about 60 before making a major high, of course, on hindsight. And what's curious here is eventually it came down and cracked below the support line. So if you connect the lows on a monthly closing basis, the monthly closing lows to a straight line connecting to this monthly closing low, eventually it broke below that. Here, that was at a price break of about $18, $19, and as of today, about 2 years later plus, it's trading at $1.25. So you have to be careful with the idea that stocks do go down, and you have to respect that. Also, we see that that happened to be a break where the RSI jumped to 3-year lows at this point, or you can even say at this point is where it moved to 3-year lows, and that was your major red flag that something was taking place in the stock. Keep in mind, when it was doing well, it was breaking out to 3-year highs, all-time highs on the monthly RSI. And now we see it changed its stripes and was trading at 3-year lows, which might explain this crack here from the higher teens and now trading in almost about to crack back. In fact, it's made a low of under $1, low of 96 cents. So the idea here is you really have to be careful when stocks are giving you sell signals. You really have to be careful with the potential for upside, because the other thing we have to also mention is if you are trying to short the stock during this move from this breakout, for example, from $30, thinking that the stock had gone so far since it had come from about $15, $14, if you short the stock here or here or here, man, you really did have a very rough going there. In fact, I have to say, lost pretty much all your money. So you have to be careful also when you're shorting stocks because of this potential upside. And be careful to short stocks that are moving and breaking and have their monthly RSI making all-time highs. Be careful to short stocks that are moving the monthly RSI above 69.10. We see that the stock eventually did come down and break below 30.90 recently, which just accelerated the move lower. So lots of things we can look at this stock on hindsight. The other thing I can see here is that there was resistance right there at about 61.8. Now all this I discuss in my videos on my channel on YouTube. So this resistance at 61.8 was probably also another red flag on hindsight. The fact that it failed to claim above that level was also something to warn you that maybe it was running out of momentum. If we take this same area at about 61.8, we can see that as it moved above 61.8, which would have been somewhere here, the stock started taking off. So it's that move above 61.8 also that accelerated this jump. Anyway, so that's how it looked like, and key there is you gotta be careful with your short ideas, long ideas, especially when they're going against you, because you never know what the downside potential is. So here's another stock in the same sector, ACI, and again we see that it too had a high, major high in 2008. Now keep in mind that the Dow made a high in late 2007 here. So at this point the Dow had been trading down while these instruments in the coal sector were trading higher. So these were probably the best performing sector commodity at the time. And so a lot of people were playing them because of their momentum. But then again, they caught up with the market. For example, ACI jumping from 65 in about 1, 2, 3, 4, 5, 6 months, from 65 back to $10. And today trading as low as 88 cents since then, despite this one slight move here from about 10 all the way to 35, which is an okay move, but you come back to the level where it stalls at about 61.8 again. There's another stall at 61.8, which is something to always keep in mind. And we also see that this happened to be a previous break point. This RSI break gave you the main high. So the RSI broke down, draw a simple straight line, and eventually the stock comes and finds resistance right there. Okay, so I want to keep this moving. And one thing I want to mention here is that one of the reasons why, if not the main reason why these stocks have been out of favor, is because the entire coal sector, now that we are looking at a Dow Jones coal sector index, and we see it's almost similar to the previous charts. And you can see here that again jumping from 750 all the way to about 100 in about 5 months during the crash of 2008. So if you were excited and were thinking that there was no way this nice moving momentum and leadership sector could go down, and you kept trying to find the bottom here, you lost a lot of money. So the key here is if you can cut your losses as soon as you're, let's say, 8% maximum down, you'd really avoid having to be in this type of a trade where an instrument moves from 750 all the way to 100. If you had cut your losses at 8%, even though at the time you might not have wanted to take that loss, and this is maximum, you can always take it at 5%. You can always do it at 3%. It's up to you, of course. Or you can combine some of this. You can have a third of your portion at 8% stop, a third of your position at 5% stop, and a third of your position at 3% stop. But the key here is don't let it go past 8%. And the reason is that once you go past 8%, the math goes and starts working against you, because it's going to take 11% to gain back 8% of your loss. So you'll need an 11% move or something in that range for you to gain back your 8% loss. And the more you go down, the worse it gets, and it means the stock has to gain so much just for you to be back in the positive area. So the key here is stocks don't generally move by their own. About 15% to 10% of a stock's move, so 10 to 15% of any stock's move is based on the sector. And you can see here that this sector has been in trouble ever since the RSI moved to 3-year lows here. Pretty much they've been in trouble, and the sector has been underperforming the market. Remember, the Dow Jones and the world markets have been trading at all-time highs pretty much around here, while this sector is trading here. So that's definitely one of the worst performing sectors in the market. So if 10 to 15% of a stock is following the sector, then you have to make sure that you understand how the sector is performing. So always keep in mind that the sector is going to be pretty much influencing what your stock is doing. And of course, the big shape here is that 75% of a stock's move, approximately, of course, is based on general market direction. So if you don't account for this 75% move or 75% influence in a stock, which is the market direction, general market direction, then you're pretty much going to be putting yourself in odd situations. If you at least have an idea of what the market could do, is doing, and taking a good account of that, knowing that 75% of any stocks in move is going to be based on this. So always account for the market first, and then account for the approximate 10 to 15% from the sector. And then now, once you account for the market, you account for the sector, then you can go and find the best performing sectors within the best stocks within the best performing sectors in the market. And that way you narrow down and you concentrate only on the best ideas in the market. Again, start with the market, go to the sector, and find the leadership sector. And within the sector, the leadership sectors, you want to find the leadership stocks. That way you're always putting yourself in the best possible light as much as possible. Which brings me to a recent great performing stock, and it's 3D Systems. And you can see this was an absolutely amazing stock between 2010 and late 2013, early 2014. I mean, the stock did jump from under $5, about $3, all the way to 95. Now that's an amazing move. And it was easy to see that people were thinking that this one was gonna continue moving higher and higher and higher and higher. But now we see it trading not at 95 or 85 or $70. It's trading at about 28. So lower 20s, and with the possibility of making lower prices, of course. And we've been short this one, or at least been thinking this was a short ever since it moved to 3-year lows, which is somewhere here. Ever since it went to 3-year lows in the 50s, we've been looking at this as a short idea because the RSI was making 3-year lows. Just like when the RSI was making 3-year highs, the stock was a buy. And that was at this breakout here at about $5, $6, $7, somewhere there. And so when things are going well, the RSI is going to be making a 3-year high plus 3-year high and above. And that's when you get this move. But when things change and you get the opposite and you get this, which I call the round trip or retracement, you can see that at that point the RSI does go on to record 3-year lows, and that's changing in sentiment, and you can see what happens once the RSI moves to 3-year lows. Point here is that do not fall in love with the stock. If you bought the stock, let's say on the way up here at $70, and you saw the stock have a nice gain, move and go to the 90s, mid 90s, and now it's back to your buy point in the 70s, you better have a stop with a maximum loss of 8%. Otherwise, you might be holding it somewhere here or be forced to get out at 20%, 30%, 40%, 50%, 60% loss. So this should always be the maximum loss on any position. Let's take a look at one that was an IPO recently, and everybody, I don't want to say everybody, but people were going crazy with this name. IPO'd here at 25, would go on to trade at a double in about 2 weeks at 50. We saw the stock eventually go and record new highs in the 90s. So this was an amazing run. But now we are looking at the exact opposite. We are back from not trading in the 90s, mid 90s. We are trading at 45, which is essentially a 50 to 40% drop. And we can see that ever since the RSI on the weekly, because remember we are looking at a weekly now, the prior charts were all monthly charts, long-term monthly. We see that every time we've been breaking and making fresh all-time lows on the weekly RSI, the stock has been going down. That's why we've been looking at this as a short. In fact, this has been a short ever since this level here in the higher 80s. The reason why I thought it was going to go down is based on the daily chart. But we still see that on the weekly there's some information, because every time it makes a fresh low again, made another fresh low below 50 there, which was this sell point in the 60s, and now we see it still continues trading at all-time lows on the weekly RSI and breaking down below the most recent weekly closing low. So here's one that could easily, for those who are buying it thinking that this was going to be the next greatest mover, and it could still be, maybe it settles down here and eventually trades in the 200s, 300s, who knows. But if you are already seeing an 8% loss in your position, then you have to be careful, because now you're opening the possibility for lower prices. And that's the key here, is if you buy it thinking it's going higher and it doesn't, have a stop, because that stop protects you from the downside. And if you didn't obey that, anybody who bought the stock on the way up, let's say in the 70s, 80s, and 90s, is now in trouble. So even the people who bought the stock in the 50s are upside down. People who bought the stock in the higher 40s are upside down. People who bought the stock in the 40s now have to be thinking, are they going to hold on and eventually hope that the stock comes back to the 90s, or are they now going to set a stop? Obviously, it makes sense for you to set a stop now that the stock has made this round trip, because you might think that it can't go below the 40s, but as we have seen over time, you never know. It could be trading in the 30s, in the 20s, in the teens, maybe even under $10, maybe even it could go to zero. And I've seen stocks go to zero. So that's the warning there. We always trade with the idea that we are going to make money, but in case we are wrong, we should set stops of about 3 to 8%, maximum being 8%, just to protect ourselves from this type of round trip. And I want to show you another here. When it comes to shorting stocks, we also have to be careful with the potential upside. Here's Priceline. Priceline has been an amazing runner. Let's go back 10 years on a monthly chart. And you can see on this 10-year monthly, stock made a low, of course, with the rest of the market here under 100. And within time, would go on to trade as high as 1300. So, and you can see that it had already moved to 3-year highs earlier in the 2005s, which was here when it was trading, let's call it at about in the mid 40s, 50s. But the idea here is that if you had shorted the stock without a stop at this any of these points in the 200s, 300s, 400s, 500s, 600s, and so on, I mean, thinking that it could not move higher, this proves that anything is possible. So the idea that you buy a stock with an idea that it cannot do this, cannot do that, it's, the stock is tied down to this range and that range and all sorts of ideas, you gotta be careful, because stocks can do anything. And here's one example where a stock just moves from 100 to 1300, and I'm sure along the way it seemed like it could not move any higher. For example, when it makes this high here at 800 and starts dropping and is now trading back below 600 at about 550, it seems like it's now going to retrace and go back to where it came from. But no, it chooses not to do that, even though that would seem logical. It moved from 100 to 800. I mean, clearly it is due for a pullback, and maybe potentially maybe back to about maybe 400, 300, maybe even back to 100. But in this instant, we see that it does the exact opposite, and from about 550 goes all the way to more than double. So that's the lesson here. The lesson here is that stocks will do whatever they want, and we have to be careful. Let's take a look at another idea, which is the NASDAQ, long-term monthly. And we can see that the NASDAQ has come from about 1300 in about 6 years, all the way to about 4,800. And so along the way, in this current market, we've been thinking, man, it can't move higher. Every time it makes a high and pulls back, man, it can't move higher. Even here, man, it can't move higher. But it has been. And ever since it moved its monthly RSI above 69.1, this one has been an absolute strong market. Almost impossible to short, to be honest with you. But let's take a look at the NASDAQ in the years before that. Let's go back to years before that. And if we take a look at the NASDAQ between the 90s and early 2000, we can see here that once it moved above the prior highs in 1995, and that was at about 750, believe it or not. That was early 95, and within 5 years, the stock had moved from 750, or the market, the NASDAQ, had moved from 750 all the way to 5,300. So it is, I guess, unnatural to have believed that, let's say when it doubled here at 1500, between here and here there was a double in price or 100% gain, that the market would continue moving higher. So even though it seems that it should have been obvious to everybody that this is where you needed to go long, let's be frank with each other, this was a scary market to be trading, because it seemed like it was due for a major correction. Okay, now keep in mind, everybody still had memories of the crash of October 87, and so this memory was still ingrained in people's minds. So it's not like they were just being stupid and buying the market. They had been warned by the crash of 87 that anything can take place. And there was also another shocking here in 98 during the long-term capital Russian market influenced drop in the world markets here, and it seemed like the rally was over. You see what I'm saying? It wasn't easy. It's just not, it seems easy on hindsight that, man, if only I had bought Microsoft in the early 1990s and sold it in 2000, I would have been a millionaire, quadruple millionaire and all that stuff. Yeah, that seems easy to say, but in truth, this is a hard market to trade, because you are expecting a pullback in the market that never comes, and you're just scared of buying the market, obviously, because the market has been strong, you're waiting for a pullback, but instead of pulling back, it starts accelerating. I mean, this is a major acceleration in price, jumping from 2,700, and in about 1, 2, 3, 4, 5 months, from 2,700 all the way to 5,000 in 5 months. I mean, this is unbelievable. So I gotta be honest, if you're a trader here, this was a very risky time to go long, and I believe many were going short naturally, just because of the natural inclining and upward sloping market. You gotta think that the next move is lower. And so at the same time, I do remember in this time frame here, people were buying the market thinking that there was more upside, buying the market thinking now the market has come back, gotta buy it. And instead of the market jumping back to 5,000, the Nasdaq would go from 5,000 back to close to 1,000 in about 2 years. And so again, we go back to that idea. If you make a trade, and because you don't know what the future brings, and that's the key, nobody really knows, you gotta make sure you have a stop. And that stop is just to protect you from the unknown. Even though you think you know and you've done your research, and you could be right, but maybe the market conditions are not conducive for gains at that time. You might be owning the best, fundamentally sound, the best growing companies in the world, but maybe the climate is not good for markets to push stocks higher. And so just in case you're wrong, and you're not always going to be right, we know that, just make sure you have a stop. Now makes you relax a little bit and protects you from owning a market that was trading in 5,000 range, and before you know it, is trading lost more than 50, 60, 70% of its gain, so of its value. So you got to be careful with the downside, or at least you got to be careful with the market going against you. Let's take a look at one more around that time frame. When we take a look at, and this one is just going to be a brief one, take a look at gold. And we see that gold here had been trading lower, coming from about, this is now gold between the 1990s, had made a high at 450, went all the way down. By 99 was trading under 250, and then jumped from, let's call it 250, 260 all the way back to about 380. So obviously you look at this and say, man, this is a roof right here. This market can't go past this level here, 450. And that makes sense, because it's come from way down here all the way back, almost all the way back to the prior high. And of course, if you are an observer, you had seen that it had dropped from this range, so you know it can go down. But what's curious, and the reason for this video, is you go back now and take a look at what happened is at about 450, which would have been this level here. Oh, it was somewhere here. And maybe even let's just draw it here. You see that what happened, instead of it going back to 250 as a possibility, not only did it break out to new highs, it moved from 400 all the way to 1900. And this is gold. This is a major instrument, a major commodity, moving from 400 to 1900 in about 1, 2, 3, 4, 5, 6, almost 6 years. And so if you try to short this instrument every time it made a high, thinking it could not go lower, you are wrong. And also those who have been buying gold recently over here and buying it and keep buying it, thinking that it has to go back to 1900 and beyond, because I remember when gold was trading here, the price target was 2000, and also people started coming up with price targets of 2,500, and it all made sense. Why not? I mean, it's at 1900. What makes it, stops it from going to 2,000? It's very close, or 2,500 if it's come all the way from 400. So which also begs the question, is it possible? And of course it is. I'm going to answer my own question, because it is possible that having made this high of 19 and now trading at 1,200, what stops it from trading at 800 or at 400 or at 250 over time? Or what stops it at trading at 3,000 over time? We don't know, and that's the key. So if you make a trade thinking that it's going either short or long, and you're not sure, the best thing to do is just make sure that you have your stop anywhere from 3%, generally speaking, maximum of 8%. So even though we all have our ideas on markets, and I'm going to conclude here with the current market for, let's say, the S&P 500. So we look at the SPX right now between 1990 and 2015, early 2015, and we can see that it is trading at about above 2,000. So even given this chart, do we think the S&P 500 is going to 3,000? Sure, that's a possibility. Could it go back to these lows at 800? Sure, that's a possibility too. Who knows? So stops and respecting that the market can do whatever it wants, because it is a market. It's going to have its own influences. It's going to have its own agenda. Eric Mwathe, good luck, peace, and blessings. Woo!